if you are looking for a new opportunity to earn decent yield, get the potential airdrop, and get exposed to new emerging markets, aka new blockchains, Zeroland is perhaps the perfect blend here. All right. So, right now, you can do all of this on this lending leading market that is currently operating on Blast, ZK Sync, Manta, Linea, as well as Ethereum, specifically leveraging the LRT narrative. All right, so that lending market exists on all of these markets, and it's leading in terms of TVL on ZK Sync and Linea. And right now, they are hinting at an additional market exposure, and based on this color, I assume it will be mode. All right, if Blast wasn't there already, I would say it's Blast, but I assume right now they will extend to mode, and let's see what happens there. Now, sorry to interrupt you there, folks. I just want to quickly chime in and mention that we are currently working on a project called Numerical. It's DeFi as a service, meaning you'll get exposed to real DeFi protocols that generate real revenue, aka real yield, and you're gonna get a cut of this without doing the setup yourself. All you have to do is enter, claim, or withdraw. Very simple. So your capital is available at all times to take, and you can choose the option where to invest. More details in the description and in our community chat. Happens there. Now, as a rule of thumb, when we talk about a lending market, it's basically a place where you supply a certain asset and then you can borrow at a specific loan to value ratio depending on what asset and borrowed asset that you're planning to borrow. And of course, there are different assets on different markets. So it's not all the same available assets on Linea versus Blast versus ZK Sync, but as a rule of thumb, you will always find Ethereum, for example, because they are all layer 2s, and or USDC, because USDC is the native stablecoin on Ethereum, and therefore subsequently the native stablecoin on all of its EVM, exception of the Binance Smart Chain. But the Binance Smart Chain is not a layer 2 anyways, but yeah, you get the point. So right now, there are 3+ methods to earn by leveraging Zeroland. So you have the native yield. So if you come here, for example, and I'm gonna take the Linea market as an example here, you see there is a supply APY that is the native naked yield that you'll earn on supplying Ethereum. And you have the early zero yield that's currently labeled right here. That's 3.08%, for example. And you can also earn on top something called zero gravity points. Now I said 3+ because, for example, on the Linea market, you can also earn Linea points and Turtle points. Now, if we, for example, shift to the Blast market, you can also earn on top of this Blast points and Blast gold points. So I'm gonna choose Blast. And I'm gonna scroll back down. You see here, on top of the zero gravity points, the native yield, as well as the early zero yield, I can also earn Blast points and Blast gold points. And even if I'm supplying an LRT like Renzo ETH, for example, I can earn Eigenlayer points as well as EZ points. So there are actually quite a plethora of earnings that you can leverage on top of the native yield. So it's not only good from a native perspective, it's also good from a future points earning orientation. All right, so it's a really cool place to be right now, and I'm not saying it's early, but disregarding the fact that an airdrop is coming within a couple of weeks, it's still a decent place to expose yourself to new emerging markets as well as earn decent native yield. Now here's the thing, if you want to take full advantage of this opportunity right now, you know, by supplying, it's good. It's decent yield. You earn 1 gravity, 0 gravity point per dollar supplied per day. By the way, that's the formula. You earn that native APR, you earn that native early zero APR, and then you're chilling, right? You're just supplying, you're not taking on any risk. However, if you want to take things to the next level, because borrowing said asset, as you can see, increases your gravity points by 4 times the normal supply amount, as well as give you 4 times the blast point, for example, on the blast market, But as a rule of thumb, borrowing an asset, because it costs more to borrow, you're gonna eventually have more risk associated to this, and therefore you should, meet that risk with a specific type of enhanced reward. In this case, 4 times more the points that you'll be earning versus just simply supplying an asset. Now here's the cool thing. If you loop it up, you can actually leverage both sides to the full extent and still remain relatively risk-free, minus the liquidation part coming from Oracle price feeds, of course, and still, earn a higher APR, or at least keep up the APR, the net APR at a certain nice level, have your health factor in check, and still leverage the full extent of additional points. And here's what I'm saying. So look at this, for example. On the blast side, your supply APY is 7.27%, whereas your borrow APY is 7.25%. So if you net these out, you're still above 0% in net APY. However, we have a 4.82% and a 1.77% respectively in early zero, and those are pluses. So if I were to supply ETH and I borrow ETH, I am in the positive still, but at the same time, I'm earning 5 gravity points per dollar supply and borrowed, and I'm earning on top of this 5 blast points, and I'm earning blast gold points. And to understand how this works, you click on details, then you enter the market. You see that the utilization rate is still low, meaning my supply APR has room for growth. So as more people come in to borrow and that utilization rate increases, the supply rate will also increase on top. So there's room for growth there. So the market and the specific market for ETH on Blast is not capped out. So if I were to loop this up, I would increase the utilization ratio slowly, of course, because at the end of the day, my loan to value will not be maxed out. There's still a bit of utilization rate in terms of growth there, but still I would help out the utilization rate, and I would basically net out on a positive side and still leverage the highest amount of points possible. Now, I would say that you can go 3 times the looping leverage and still maintain a health factor between 1 to 1.3. Remember, if you drop below 1, means you're going to be liquidated, all right? So just keep that in mind. But if you are playing this from a delta neutral side, so supply ETH, borrow ETH, supply USDC, borrow USDC, as long as, remember, the supply side is equal, slightly higher, or it could be a lot higher, of course, or slightly lower from the borrow side, it is a very lucrative approach to do. However, if the borrow side is increasingly higher than the supply side, it's pointless. You're gonna end up with a net negative APR that heavily, offsets the points that you'll be getting on the other side. So I'm gonna go back here and check if there's, for example, look at USDB. The supply side is heavily higher than the borrow side. So a delta neutral 3x looping strategy on USDB is a no-brainer in my personal opinion, right? So you're gonna still earn that native APR plus all of these points on top. And USDB, by the way, is the native stablecoin of the Blast blockchain. All right, so just keep that in mind. It's not some shady derivative coming on from a third party. It is the official stablecoin on Blast. And one thing to note as well is that, for example, the LRT strategy is isolated, meaning you cannot use this as collateral to borrow. You just can deposit and earn these points. You can clearly see that there's no native APR, nor there is an early zero APR. It's just points that you'll be getting from providing ETH at ETH. But that's a different thing, all right? I'm talking about the other strategies where you can loop in collateral, borrow, and then redeposit, and then borrow again, and potentially redeposit. That's your 3x, all right? Keep that in mind. So overall, you can play with the numbers, with the health factors, you can explore opportunities, but I'm just here to tell you that keep that formula in mind, right? So the borrow side should not outweigh heavily the supply side. I think I can see an example if I go, for example, on the ZK Sync side, potentially the delta neutral strategy for stablecoins is not lucrative. So I come here, I look at USDC, you can clearly see that the supply side is much lower than the borrow side. So doing this strat, meaning looping using bridged USDC, is gonna be detrimental. It's not good. In my personal opinion, you'll get negative, and then the points that you'll be getting won't offset that negative side, that negative strategy. So you can actually leverage this strategy on other markets using other assets, so far at least, because there's not much interest and the utilization rate allows you, and the opportunity to enter before it grows to a level where it's not lucrative anymore. So you should always monitor this, and you should always, keep that in your mind. Now, just to give you an idea of what the potential could be for a zero airdrop, right now you can get a glimpse of the zero current price from pre-markets, like for example whales markets, where you can, for example, look at the pre-market price of zero. Currently it's at about 2.5 cents, not so bad. So basically what I'm telling you here is that you can take the amount of early zero tokens and multiply it by the price to get a feel of how much you'll be getting. That's one thing. And also the points side is basically the zero gravity points, where you can also get a feel of multiplying the amount of points by the price of 1 point on the whales market. So this is the only place where you can get the feel of how much demand there is on the point side of things. But on the token side of things, Ivo, for example, also listed zero, and it's currently trading at a discount. It wasn't so long ago where this price was almost at 0.5 cents. Now it dropped drastically, but I wouldn't get discouraged, because at the end of the day, pre-markets are just there to give you a hint of what could be possible. If I actually make this bigger, you can clearly see when or where it started versus where it is right now. So it is heavily dumping between quotation marks, but I wouldn't be so quick to go and sell my points and my tokens right now, right? So it's still early stages. We don't know where this will be, but just to give you an idea, if you look at DeFi Llama, you can clearly see the Zeroland growth. It's currently at 200 mil, and it is, like I said, a lending market that has entered leading and emerging markets. So it's not basically going on chains where it's already capped in terms of lending protocols. It's trying to leverage the new layer 2s that are coming up and trying to take a piece of the pie of whatever TVL is there. So that's very smart, and I think because of this strategy, they will potentially be the Aave of these markets. Because, right, if you are familiar with Aave, you can clearly see that this is the setup that they have in terms of user interface and experience, and that's what Zeroland is adopting, just to give a feel of, all right, listen, Aave is leading on Ethereum, Arbitrum, Optimism, etc., but Zeroland is there to mimic the success of Aave on these emerging markets. We do have a nice Telegram chat. We do talk a lot about crypto and DeFi. Be sure to join us if you are one of us, in terms of a person who's willing to learn, a person who's willing to give their opinion. You won't regret it. And with that, see you in the next one. Have a good one.